Hi there, everyone. Thanks for listening. I'm your host, Dan Butcher, AFSA's Director of Communications. In this episode, we chat with Solomon Semere, Senior Director of Credit and Marketing Strategy, and Craig Stockum, Sales Director, both with LexisNexis Risk Solutions, about the uncertain risk environment in which we're currently operating. Specifically, Craig and Solomon touch on some driving trends that are affecting consumer demand and market opportunities, and what lenders need to do to adjust their strategy to meet the consumers they're looking to attract right where they are. This was a great conversation, and it includes a ton of great tips for helping you manage risk while reaching your target audience. And now I bring you Solomon Semere and Craig Stockum. Hi there, everybody. Welcome to the episode of the AFSA Extra Credit Podcast. We are joined here by Solomon Semere and Craig Stockum, both from LexisNexis. Hi, guys. How you doing?
Terrific, Dan.
Great.
Thank you.
Very good. That first voice you heard was Craig, and that second voice is Solomon. We'll kind of call that out as we go along here. But today we want to talk a little bit about navigating with confidence under the umbrella of economic uncertainty. And let me tell you what, it is a heck of an umbrella because we're kind of in the middle of a thing here. And so a lot of what we're going to talk about today is kind of trying to navigate how that works and how we can, as businesses and business owners, kind of make the best of what's there. And so, I want to toss it out to you guys first, and either one of you or both can answer. Just feel free to take it from here. We historically speaking, the market kind of has a generally cyclical demand and level of predictability when you're talking about origination volume, particularly. The last 18 months, however, has been fair to say volatile at the very least in the market. So what are some of the driving trends you guys have seen coming out of the pandemic itself?
Yeah. Thanks, Dan. I can jump in here. And so the way we look at this is really in two parts. One is from the consumer side, how that demand has changed. As you mentioned, we've seen a lot of changes over the past, almost 2 years now. And then also on the market side, how are lenders responding? What do they perceive as the level of risk, and how has that changed over the past year and a half? So starting with that, starting from a kind of credit quality standpoint, I think what's interesting, and some of your listeners may have picked up on and noticed already, is that credit quality and credit scores really as a measure of credit quality are at all-time highs. And so if you look at some of our peers, you look at the FICO score. I think they just came out with the average FICO score in around 720 now, and same thing with the Vantage. I think it makes sense when you think about delinquencies also being at near record lows. Credit utilization near record lows, and a lot of that just reflects the impact of government programs, and then also a recovering economy. And so we've seen the same kind of trends. And so what's interesting from the demand side is that it kind of diverges when you start breaking it down by market or product or type of lender. And so starting with kind of your traditional bank or bank card, retail credit card, your DDA accounts, kind of your mainstream bank products. What we saw in 2020 was really depressed demand from a consumer standpoint, and that's a combination of factors. So, especially the mainstream institutions were just very leery of the amount of credit risk that they expected to materialize. Again, hasn't really. And then also just the government programs that really replaced a lot of the need for private credit. And so we see things like, your high interest kind of loans, installment loans, subprime, way down, 30-40% most of last year, and just even less on credit cards, where consumers are spending a lot less, or at least last year we're spending a lot less on travel, dining, those kind of things. But when you look at this year, what we've seen, and so in 2021, the theme has kind of been a really strong rebound in that space. So across the board, DDA accounts, credit cards, installment loans, and that's been spurred by the stimulus in January, and then also in March, and it's continued. What's really interesting is where that demand is coming from in kind of this bank space, and it's being fueled predominantly by kind of the thin file subprime population. And we've seen when you look at kind of this credit invisible world, application activity rising about 40% since even the pre-pandemic levels. And same thing with the subprime population. So what we've seen is that this again really reflects the impact of the government programs as the government kind of has pulled back from some of those transfer payments. Consumers are kind of lessening their dependency on government and turning back to kind of private credit, if that makes sense. Another trend is in kind of this buy now pay later space, which is really hot, and what we've seen there is really explosive growth, triple digit growth, young shoppers, looking at a consumer friendly way to finance purchases. And then also kind of, a lot of these traditional institutions that were nervous about the level of risk kind of ceded some territory to these players, and they came and swooped in and really, replaced a lot of the credit, the supply that was being provided by kind of your retailer credit card companies. So, and what's interesting in that space is, the barriers to get a loan and get approved are low. So what we're starting to see is a pickup in risk out there. I think obviously a big area for your listeners in the auto space, I think we want to spend a little time on. We're really seeing some interesting trends. Last year wasn't from a kind of auto sales or even financing activity in 2020 actually wasn't as bad as I think some expected. With some favorable interest rates and a lot of competitive pricing out there. Consumers were out shopping. So kind of the market stabilized towards the end of the year and then really picked up at the beginning of this year. The stimulus checks, we could tie it right back to then. March, April, just huge demand, some record months. But what we've seen since then, and I think this has kind of been reported everywhere, is that the supply issues, increasing costs of especially used cars, increasing cost of gas even, has really started to price a lot of the subprime population out. So the kind of subprime and credit invisible world we've seen kind of that shopping and credit seeking behavior way down since March, and really what you're seeing is more the kind of shoppers that are out there for vehicles that really haven't been priced out are kind of your more near prime and prime population. So again, kind of the inverse of what we're seeing in the traditional banking space that we see in auto. And I know, Craig, you have with all of the lenders and manufacturers you work with, I know you have some thoughts on kind of what's driving that in particular.
Yeah, Solomon. And I think you hit on the fundamentals, and we're talking about trends particular to auto, right? A lot of it started, or maybe precipitated by COVID, right? Major trend towards digital retailing, and well, I'll put omni-channel presence under that category. So we see a major drive that continues, and I think that was the big question last year. Consumers who could not physically go into dealerships, right? Lenders had to very quickly adapt and bring forth digital retail models. And I think the question had always been, is that a short-term fix, or is that an acceleration of where we will eventually end up? And I think the answer is we're seeing more and more entrance into the market. We're seeing more focus on a digital on sustaining digital capabilities. We're actually seeing changes now that sort of stem from the fintech online lending space in the form of more pre-qualifications on the credit side as opposed to hard inquiries. And that's all consumer bias driven, I believe. The other trend, and I think Solomon touched on this, and a lot of this has to do with very limited inventory supply, and it's sort of a perfect storm created by chip shortage, is the extremely high, historical high vehicle valuations are keeping consumers out of the lease market, keeping consumers out of the loan market. Folks are holding on to the vehicles much longer, and that creates an issue that we've got to be aware of down the road, in that what is today a 110% loan to value As the industry does normalize and inventory flow comes back, some of those LTVs will look like 115%, 117%. So what's inside credit policy today as inventory levels change poses a particular risk on the credit side relative to vehicle valuations and what they're originally booked at. And I think that's something that we need to keep an eye on.
This episode of the AFSA Extra Credit Podcast is sponsored by LexisNexis Risk Solutions. LexisNexis Risk Solutions harnesses the power of data and advanced analytics to provide insights that help businesses and governmental entities reduce risk and improve decisions to benefit people around the globe. They provide data and technology solutions for a wide range of industries, including insurance, financial services, healthcare, and government. Learn more at LexisNexisRisk.com. You addressed it slightly about, the government programs and the power they've had for a lot of consumers around the country. But you talked about some of the unknown implications about what happens when those programs end, and them being unknown. I understand that this question is unfair, but I wonder if what are some of those things that you're looking for when we're talking about some of those? What could we see occurring when those government programs start to peel away?
Yeah, I think there are a couple of things at least that I'd point to just as examples, but there's I think a number of different kind of consumer signals and behaviors you can look at. One thing is that I mentioned that kind of this credit utilization or kind of a need for credit has been dampened by a lot of the government stimulus. So whether it's the checks that went out, or even something like PPP, which ultimately, redounds down to the employees at these small businesses. The thing we're looking out for is that utilization starts to go up as consumers start putting more on their credit card, or they start taking out, higher dollar installment loans or short-term loans. So we have seen some of that activity. So that's one thing I think we're very mindful of. Another area which is pretty interesting, and it kind of gets to the question, and one of the things that we kind of stress to all of our partners or lenders we work with is really looking at a broad set of data is around kind of residential stability. Whether that's people, renters or even homeowners moving. And what we've seen is that a lot of the government programs around eviction moratorium, for example, or mortgage forbearance, what that's done, and again, this was obviously the goal of these programs was to stabilize kind of the residential the stability of consumers, and so when we look at pre-pandemic versus post-pandemic, we've seen about a 40% drop in people moving within 12 months. So these are consumers that typically would move multiple times within a year. About 8 million individuals that were kind of in that boat. That you could say you usually wouldn't make it through kind of a typical 12-month lease. Those consumers are moving less, so across the board, kind of greater residential stability. So likely these are people that are beneficiaries of some of the programs around eviction moratoriums, forbearance, things like that. Also, there's consumer behavior. People just aren't moving as much for jobs, a lot more remote. But now, some of those protections have been removed and are going to continue to be removed. And if you're a renter, you may have a lot of back kind of rent to pay, or you may be forced to move. And we see that kind of greater instability and risk is potentially a leading indicator of, consumers being more stressed, putting more on their credit cards, not being able to pay back, your phone bills or credit card bills or different loans. So it's things like that we track that are kind of outside of the mainstream information that you might get from a traditional kind of credit report.
Great. Thank you, guys. One of the other things here is you talked a little bit about hidden risk among consumers, regardless of credit segment, and also the need for lenders to be more competitive. What are some of the things lenders can be doing to help drive consumer engagement while still being mindful of that risk potential, keeping that risk potential front of mind for their businesses?
Yeah, I think it comes down to this broader idea of customer experience, with which Craig touched on. So when you're starting to see the shift, especially with these younger consumers, everything's about doing things digitally, faster, easier, convenient. At the same time, lenders, they don't, just want to approve everyone. They have to maintain a certain level of, profitability. And so kind of driving that automation, but also managing risk is a challenge that we on a daily basis are helping our lenders with, on the front end, then also on the back end when you do approve someone, managing your portfolio to make sure that you're taking the appropriate actions and monitoring risk. So our view is that the best kind of approach is kind of, especially from a data perspective, is to be as holistic as possible. Really look for information that's not, readily available to everyone else, which will allow you to kind of make differentiated decisions, faster decisions, on the risk that you're willing to take. So, it doesn't mean to, kind of just look at kind of, some of these exotic data sources or non-traditional things. Obviously, you have to think about from a compliance standpoint and also just from a reputational standpoint. But there's just a lot of information that's out there that will allow you to kind of attract the type of consumers that you want, both on the kind of customer acquisition side, if you're doing marketing pre-qualification, identifying the right consumers up front, so you don't have to take them through a poor experience where they're going to get declined anyway. And then also, at the point of sale, quickly making a decision. I think those are kind of all of the critical things where we're trying to help our customers with.
Great. Just anecdotally talk about some of the, meeting consumers where they are. And we've seen a ton of that with all of our members, but particularly auto members, shopping around online, still coming out to the dealership, making people feel comfortable there, driving the cars, getting financing. All of that stuff is meeting consumers exactly where they want to be, which is critical, as you said. So, one more here before I let you go. Talked a lot here about credit profiles and risk and whatnot. If credit profiles have become so muddied and confused, particularly in the world we live in right now, and traditional data is not really giving you a complete view of what you're looking for in terms of risk, what do lenders need to be doing now to adjust their strategies so they can better take advantage and attract consumers that they want to have in their family?
Yeah. So I think the way we look at it is kind of, in all of the above approach. It's still looking at some of the traditional data. We think that's, always going to be critically important, but supplementing that with really complementary, non-traditional, we call alternative data. And from our standpoint, that's an array of, we're looking at an array of data sources. At LexisNexis Risk Solutions, we're aggregating from over 10,000 sources and looking at things like inquiry data, occupational data, educational data, business association, derogatory data. So kind of all of these things alongside the traditional data will give you a complete picture. And really, I think there's a couple areas where we find you get kind of the most benefit. So one is around this whole idea of financial inclusion. So in this thin file, new to credit space, what we find is by using kind of a broader, more holistic view of data, those numbers are throwing 50, 60 million consumers out there that don't have a traditional credit score. You can pretty much score the majority of those consumers once you start looking at broader pieces of information. And what we find is that a lot of those consumers turn out to be actually creditworthy and perform like your kind of near prime or prime population. So maybe they're on the borderline of kind of a subprime. But if they were given access to credit, They could be swapped in at a pretty good rate. So for prime lenders, there's another benefit which is around more around identifying risk that's potentially out there that hasn't been identified through traditional measures, and then also just better pricing. And so this goes back to the concept of improved customer experience. So it's really around taking a kind of look across the credit spectrum and identifying pockets that may be overlooked, and then maybe identifying those pockets of consumers that everyone is kind of going after, your prime consumers, that there may be some indication that maybe you're not as aggressive in that population. And so that's kind of been our history of kind of the benefit of using different data sources. But again, like you said, Dan, it's really about doing the analysis, kind of getting through that muddled picture that's out there, because there's just so much data, and not all of it is going to be predictive.
Yeah, along that note, Solomon, and somewhat of an extension of it, I think it's important that lenders find credit data that's meaningful to the population that they're targeting. If we rewind 5 to 8 years, array of alternative credit data sources out there, many of which were sort of built for either subprime population or underbanked, that don't really have much lift or predictive value in the near prime or prime or even super prime space. Oddly enough, there is a lot of risk separation that can be had in the prime sector, and that's where I think lenders have the opportunity to create higher auto approval, higher auto decisioning rates, better efficiencies, and ultimately that's all. Those are all variables that drive profitability, and in driving better profitability, it continues to be a cycle. Then they're able to put more competitive offers out into the space. So I think aligning credit data sources to your population to find those that do provide meaningful lift and credit risk separation is sort of critical to continued growth.
Solomon and Craig, thanks so much for taking some time with us today and explaining that for us. Folks, LexisNexis Risk Solutions is on top of all this stuff, so we'll be sure to include Craig and Solomon's contact information in the show notes, as well as in the blog post that this is attached to. Craig and Solomon, thanks so much for joining me.
Thank you.
Well, thanks for having us, Dan.
AFSA hopes you've enjoyed this edition of the Extra Credit Podcast. Don't forget to follow AFSA on Twitter at AFSA_DC and on LinkedIn. Just search for the American Financial Services Association. You can also follow AFSA's SGA team on Twitter at AFSA_SGA. The blog at AFSAonline.org is also a great resource for the most up-to-date news. If you've got questions or if you'd like to suggest a guest, please shoot us an email at communications@afsamail.org or tweet at us. Join us next time for more Extra Credit. Thanks for listening.